On Friday, May 31st, 2026, the global benchmark price for Brent crude oil closed at 92.56 cents. To an investor tracking market indices on a screen, this number signals market stability. Yet, beneath this veneer of calm, a systemic tax has rewired international trade. Iran has imposed a levy of exactly $1 on every single barrel of crude transiting the Strait of Hormuz. This fee is not payable in United States dollars. The Islamic Revolutionary Guard Corps demands payment exclusively in Chinese yuan or digital stablecoins, turning a highly transited international maritime choke point into a state-run toll road. To understand why global shipping conglomerates paid this ransom all spring, one must analyze a geographical opening just 21 miles wide. This narrow strip of water separates the northern coast of Iran from the rugged cliffs of Oman. Through this single valve passes 27% of the planet's maritime petroleum trade. Every 24 hours, 21 million barrels of oil, 1/5 of the total volume consumed by global civilization, must thread this exact needle. Saudi crude, Iraqi crude, Kuwaiti barrels and Qatari liquefied natural gas all share this identical, non-negotiable path. The valve seized on February 28, 2026, when American and Israeli forces launched a wave of missile strikes against military infrastructure inside Iran. 4 days later, on March 4th, Tehran retaliated not with a conventional naval deployment, but with asymmetric friction. Iranian forces declared the Strait of Hormuz closed to hostile traffic, deploying a network of sea mines, loitering munitions, and fast attack craft. They did not need to defeat the United States Navy in an open fleet engagement. They only needed to sink 2 commercial tankers, killing 5 crew members, to force every maritime insurance underwriter in London to raise transit premiums. Commercial traffic through the strait instantly collapsed by 90%, leaving hundreds of fully loaded tankers idling on both sides of the water. For the remaining 10% that chose to move, survival required entering an unwritten bureaucratic loop. Tanker operators now contact intermediaries directly connected to the Revolutionary Guard to negotiate safe passage. The price settles at up to $2 million per voyage wired through shell companies via cryptocurrency or settled through physical barter. Once the blockchain verifies the transaction, Tehran issues a specific radio protocol code. As a compliant tanker approaches the pinch point, it broadcasts this digital passcode over open VHF radio frequencies. An Iranian fast patrol boat intercepts the vessel, not to seize it, but to escort it through territorial waters, slipping between coastal islands to avoid its own floating mines. Between March 1 and March 15th alone, 90 vessels transited the strait using this precise clearing mechanism. The United States government found itself trapped in a systemic paradox. Sanctioning the shipping lines that paid the ransom would instantly halt the remaining trickle of Persian Gulf oil. Triggering the exact global energy shock Washington sought to prevent, superficial commentary frequently compares this crisis to the 1973 Arab oil embargo, when prices quadrupled and forced Western economies into structural paralysis. That comparison misinterprets the architecture of the modern energy market. In 1973, the industrialized world possessed no domestic cushion, relying entirely on a handful of Middle Eastern valves. In 2026, the United States stands as one of the world's largest oil producers, buffered by massive strategic reserves and alternative energy infrastructure. Iran cannot cause a total collapse of Western civilization. Its leverage operates on a much more precise inflationary frequency to stabilize the panic. The International Energy Agency authorized the release of 400 million barrels of crude from global emergency stockpiles. The headline figure sounds immense, but the physical math reveals a harsher reality. At a global consumption rate of 105 million barrels per day, this intervention covers less than 4 days of total planet-wide demand. Measured against normal flows through the Strait of Hormuz, the entire global emergency reserve provides a cushion of exactly 20 days. The structural deficit remains untouched because the physical movement of ships through the water remains dictated by Tehran. Consequently, the global economy is not shattering. It is bleeding slowly through minor structural increments. The prolonged maritime bottleneck has pushed American inflation to a multi-year high, forcing the Federal Reserve to contemplate further interest rate hikes. This dynamic transforms a regional shooting war in the Persian Gulf into a direct penalty on home mortgages, corporate credit, and consumer purchasing power half a world away. Iran discovered that it does not need to destroy the Western financial system when it can simply force that system to price in the permanent cost of its own insecurity. The true systemic fracture, however, did not emerge from the missile exchanges or the naval blockades. It came from an unexpected policy shift within the United Arab Emirates, the Gulf's third-largest oil producer. In a sudden announcement that caught global energy markets completely unprepared, Abu Dhabi declared it was leaving OPEC and the wider OPEC+ alliance to pursue its own national interests. For half a century, this cartel has dictated the global price of oil by forcing its members to adhere to strict production quotas. By cutting this cord in the middle of an active war, the UAE initiated the dismantling of the post-war energy order. Abu Dhabi did not take this step out of geopolitical panic. It acted on cold infrastructural calculations. Behind its desert perimeter, the UAE has quietly completed nearly 50% of a second pipeline project. This steel conduit runs directly from the oil fields of the interior to Fujairah, a deepwater port situated on the Gulf of Oman, entirely bypassing the Strait of Hormuz. The existing infrastructure could already move 1.8 million barrels a day around the Iranian trap. The new expansion project aims to double that capacity, allowing the UAE to dump 5 million barrels per day onto the global market without asking permission from a cartel or a gatekeeper. Sultan Al Jaber, the head of Abu Dhabi's national oil company, framed this development not as a commercial expansion, but as a direct defense against an arithmetic of extortion. His internal data reveals that over 1 billion barrels of crude have already vanished from global supply chains since the closure, with another 100 million barrels disappearing every 7 days. Even if a permanent peace treaty were signed tomorrow morning, restoring normal maritime transit to just 80% capacity will take a minimum of 4 months. Full normalization will remain impossible until well into 2027. The physical arteries of trade are already clogged, and as the diplomatic facade begins to crack open, the architecture of the open sea has just entered its most volatile transformation since the mid-20th century. The physical reality of an interrupted oil flow is that the commodity cannot simply be paused. By the first days of June 2026, the primary storage terminals of the Persian Gulf have transformed into massive structural dead ends. The tank farms at Ras Tanura in Saudi Arabia and Mina Al Ahmadi in Kuwait have hit 97% of their absolute physical capacity. Millions of barrels of oil are extracting from the earth every hour, but with the Strait of Hormuz blocked, there is nowhere left to store the volume. This introduces the technical crisis of a forced upstream shut-in. An oil well is not a simple tap that an engineer can close without consequence. In supergiant reservoirs like Gawar or Bergen, halting the continuous upward flow alters the delicate hydrostatic equilibrium of the underground formation. The sudden drop in pressure causes water tables to encroach into the wellbore, while heavy organic compounds called asphaltenines precipitate directly into the microscopic pores of the reservoir rock. A forced shutdown does not preserve the oil, it permanently chokes the geology, destroying up to 20% of a field's ultimate recovery potential forever, as the physical infrastructure approached its limit. The international financial safety net tore open from within. On June 1st, the Joint War Committee of London's maritime underwriters officially designated the entire Persian Gulf as an uninsurable transit zone. The Standard, Protection and Indemnity Clubs completely withdrew their sovereign liability coverage for commercial vessels entering the region. Overnight, the premium for a single 7-day war risk binder on a very large crude carrier surged from $50,000 to $4.8 million. This premium increase broke the economic logic of legitimate maritime trade. Blue-chip shipping conglomerates, including Maersk and Euronav, ordered their fleets to drop anchor outside the Gulf of Oman and deactivate their automated identification transponders. This operational exit surrendered the waterway entirely to the shadow fleet, a loose network of aging, single-hulled tankers flying flags of convenience from jurisdictions with zero safety oversight. These substandard vessels became the exclusive clients for Iran's clandestine passcode system. paying the $2 per barrel ransom via untraceable stablecoin transfers to the Revolutionary Guard. The technical failure quickly metastasized into an ecological catastrophe that crippled the region's internal life support systems. On June 3, an uninsured 30-year-old shadow tanker loaded with 2 million barrels of Basra heavy crude struck a drifting contact mine 4 miles north of Larak Island. The underwater blast vaporized the vessel's midsection, releasing 240,000 tons of heavy sulfurous oil directly into the shallow enclosed basin of the Southern Gulf, because the Persian Gulf operates as a closed ecological loop with a slow, counterclockwise current. The massive slick did not dissipate into the open ocean. Instead, the oily sludge migrated directly toward the industrial seawater intake valves of the Al Jubail desalination complex in Saudi Arabia and the Ras Abu Fontas facility in Qatar. These facilities process seawater to generate 85% of the municipal drinking supply for the region's urban centers and provide critical cooling water for heavy industrial infrastructure. The oil slick clogged the desalination membranes, forcing immediate emergency shutdowns across both complexes to prevent permanent chemical contamination of the civilian water supply. The abrupt loss of industrial cooling water triggered automated safety trips across 3 primary natural gas liquefaction trains in Qatar. This mechanical shutdown instantly removed 12% of the global liquefied natural gas supply from the international market. To prevent immediate domestic water starvation, regional governments diverted their entire civilian power grids to run emergency underground brackish pumps, initiating rolling electrical blackouts across vital energy extraction sectors. Every structural fix attempted by Western allies only accelerated the internal collapse. In an effort to bypass the paralyzed strait, Saudi engineers attempted to force the absolute maximum volume of crude through the East-West Petroline, a 745-mile pipeline terminating at the Red Sea port of Yanbu. The pipeline's pump stations possess a strict mechanical tolerance ceiling of 5 million barrels per day. Forcing 6.8 million barrels through the aging steel conduit caused a massive hydraulic pressure surge near Afif, fracturing a primary manifold station and taking the entire continental bypass line offline for months simultaneously. The structural collapse dismantled the global commodity clearing mechanisms. On the Intercontinental Exchange in London, the margin requirements for Brent crude futures contracts exploded by 400% within a 24-hour window as automated trading algorithms reacted to the Qatari LNG shutdown. The sheer scale of the price swings overwhelmed the liquidity cushions of major European commodity trading houses. 3 mid-sized trading desks failed to meet overnight margin calls totaling $14 billion, freezing their credit lines and triggering a liquidity lockdown across Western commercial banks, with traditional financing frozen. The fragmentation of the global currency reserve system accelerated. Bypassing the paralyzed Western banking network, Iraq began settling its crude oil transactions exclusively through digital stablecoins deposited directly into unregulated ledger accounts controlled by regional paramilitary groups. The United Arab Emirates, operating entirely outside OPEC quotas following its exit, began routing its unblocked Fujairah crude exclusively to state-backed refineries in eastern China, accepting payment in digital yuan. The petrodollar system, which has underwritten the global dominance of the United States dollar since 1974, dissolved into a multi-currency barter network over the course of 72 hours. The shockwave has now penetrated the foundational layer of global manufacturing. In East Asia, the sudden cessation of Qatari gas shipments and the skyrocketing cost of uninsured shadow fleet crude forced petrochemical crackers across Japan, Taiwan, and South Korea to slash their output of ethylene and industrial polymers by 40%. These compounds are the indispensable primary materials required to manufacture automotive electronics, medical hardware, and semiconductor packaging. The global industrial apparatus has completely exhausted its safety inventory. The system has run out of structural dampeners. The physical storage tanks are full. The deep underground geology is suffering permanent degradation. The regional water infrastructure is failing, and the international financial clearinghouses are facing systemic illiquidity. The crisis is no longer a localized disruption of supply. It has evolved into a self-reinforcing chain reaction that is systematically dismantling the industrial and monetary architecture of the modern world. The point of structural equilibrium has vanished, and the global economy is now accelerating down the incline of its own dependency. By the second week of June 2026, the industrial paralysis, triggered by the 40% drop in East Asian polymer production, has arrived at Western container terminals. Component shortages have forced assembly lines to halt across Germany's automotive manufacturing centers and America's medical equipment facilities. The maritime logistics chain has internalized the friction. The spot rate for shipping a standard 40-foot container from Shanghai to Rotterdam has climbed from $2,500 to $14,200. Vessels attempting to bypass the region entirely by routing around the Cape of Good Hope are adding 28 days to their voyages, burning an additional 800 tons of fuel per trip, and permanently reducing global maritime transport capacity by 15%. This is a structural surcharge on every imported consumer good independent of the daily fluctuations in crude oil prices. The systemic contagion has breached the global agricultural apparatus. Because Qatari natural gas liquefaction remains paralyzed by the regional power grid failures, the production of industrial ammonia, the foundation for 70% of global nitrogen-based fertilizers, has contracted sharply. International fertilizer benchmarks have surged by 65% in less than 20 days. This agricultural input cost guarantees a downstream escalation in global food prices by the third quarter of 2026, transforming an energy delivery bottleneck into a systemic threat to basic food security across import-dependent urban centers in Europe and North Africa. The crisis has completely decoupled consumer prices from central bank monetary policy. In Washington and Frankfurt, central planners discover that traditional interest rate adjustments are mechanically incapable of resolving a physical supply disruption. Raising borrowing costs cannot clean an oil-soaked desalination membrane or repair a fractured pipeline manifold in the Saudi desert. Consequently, domestic inflation metrics have accelerated past 8.4%, while the baseline interest rate for 30-year fixed mortgages in the United States has breached the 9.5% threshold. The cost of money is rising precisely because the physical velocity of global trade has dropped. The geopolitical winners of this structural realignment are cementing their positions in the East. By utilizing its cross-border interbank payment system and settling transactions exclusively in digital yuan, China has secured a continuous supply of heavily discounted crude from both Iran and the unaligned United Arab Emirates. Beijing's strategic petroleum reserves have grown by 120 million barrels since the start on conflict, filled with oil purchased at a 25% discount relative to the Western spot market. Simultaneously, Russia has successfully rerouted its entire Siberian and Arctic crude capacity to Asian markets, securing long-term bilateral purchase agreements that completely bypass Western maritime insurance jurisdictions and the SWIFT banking network. Conversely, the Global South is absorbing the direct, non-negotiable cost of this Western-Iranian standoff. Developing nations that rely entirely on the open market for spot price energy imports are facing immediate sovereign insolvency. In South Asia and East Africa, national electrical grids have cut power to industrial manufacturing zones for up to 14 hours a day to preserve dwindling diesel stockpiles for agricultural transport and emergency medical services. Pakistan, Bangladesh, and Kenya are depleting their remaining foreign currency reserves at a collective rate of $650 million per week simply to finance emergency fuel shipments from non-Gulf suppliers, forcing immediate emergency loan renegotiations with the International Monetary Fund. The diplomatic mechanisms deployed to halt this systemic hemorrhage are fundamentally disconnected from physical reality. The United Nations Security Council continues to debate a draft resolution to enforce free transit through the Strait of Hormuz, but the text remains permanently blocked by the strategic vetoes of Moscow and Beijing. Even if the pending 60-day ceasefire memorandum of understanding is finalized by Washington and Tehran, it represents an administrative illusion. A signed piece of paper cannot instantly reverse the physical degradation of the subterranean oil reservoirs. Restoring normal flow requires thousands of chemical well workover procedures to clear precipitated asphaltenes from blocked rock formations. A technical process that cannot be legislated into existence. The architectural damage to the global energy system is already irreversible. The unilateral exit of the United Arab Emirates from OPEC has permanently fragmented the half-century-old structure of coordinated oil pricing, replacing it with an aggressive multipolar race for regional market share. The Fujairah pipeline expansion project proves that regional powers no longer believe in the institutional protection of the open sea. National energy security is no longer built on international maritime law. It is being carved into the physical geography of sovereign deserts by countries routing entirely around the traditional infrastructure of trade. The ultimate casualty of this crisis is the foundational principle that underwrote global prosperity sink, E1945, the absolute freedom of maritime navigation. Iran has demonstrated to a coastal state flanking a critical maritime choke point that international trade can be selectively taxed, intercepted, and ransomed with complete impunity. If the state-run toll system in the Strait of Hormuz is formalized into a face-saving environmental levy to secure peace, the operational template will be instantly duplicated across the Bab el-Mandeb, the Bosphorus, and the Malacca Strait. The era of a singular, integrated global marketplace has ended. What remains is a highly fractured, high-friction international system where security is an expensive, localized commodity. The market index displaying Brent crude at $92 is a metric of exhaustion, not stabilization. The global economy did not experience a catastrophic, single-day collapse because it possessed just enough structural elasticity to avoid absolute failure. Instead, it has accepted a permanent, systemic tax. A slow, continuous drain on capital, currency stability, and industrial output. The world has not resolved the blackmail. It has simply adjusted its baseline to live inside the trap.